I see somebody. Who could this be? Hi, Rodrigo. How you doing? Can you hear me?
Yeah, I can hear you. Good morning.
I can hear you. Over and out.
Yeah,
Just give me 1 second to turn this cell phone off.
yeah, no problem.
Okay, now it's been silenced. So how we doing? You did all right on that first test, huh?
Oh yeah, you saw that already, huh?
Yeah. I saw the grade. You were way up there. You were at the top of the class, right? What'd you get on? Like a 90 something? Or?
Yeah, I should have done better though. It's like I rushed through it. That's the next part. I'm gonna take my time.
Yeah, that can be a cause of trouble, no doubt about that. And also it was a big test. I mean, they split it up into 2 parts.
Yeah, I kind of like that because I think the first three, I think I was overconfident on the first 3 chapters. So I just kind of went click, 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 click. I'm like, I did good. I think there was only 2 I thought I didn't know.
Yeah.
And then those are the 2 I missed plus another one.
No, I'm not. You did good. You done good. Maybe we'll give Anthony a minute to join us. I assume he's coming in because he's not missed yet.
Yeah.
And as you know, we're skipping chapters 7, 8, 9 until the end of the class, and for good reason. We want to stay in the mode that we're a merchandising business.
Yeah.
In chapter 7,
I think I've already finished chapters 10, 11 homework.
Okay, great.
I started 13.
Excellent. Are you going to be taking 230?
Yeah. This summer, hopefully.
If this
what
was
I'm trying to do,
pardon me?
I'm trying to get into this master's program.
Oh, wow.
For taxation.
Oh, good for you.
And what I needed was like 8 units of accounting, which I never had because I was double E.
Ah, okay.
But I do have my enrolled agent.
What's that again?
I'm an enrolled agent.
Oh, really? Wow.
So
who do you work for?
Myself.
Okay.
So that was my hobby. My dad is a tax preparer for like 30 years. And so I've helped him do taxes.
Yeah.
And in the process, I remember I was kind of listening to an audit, and the auditor told him to be quiet, and he wasn't allowed to speak when he asked the client something or other. And later I asked the guy, how can you do that? He goes, well, he's not a CPA, he's not an EA or a tax attorney.
Yeah.
So I said, well, I'm going to look those up. And then I said, oh, EA is easy to get. So I did the EA test.
Good for you. So how many credits do you get out of this class? 3 or 4?
I don't know.
I think you get 3.
But then, I'm not sure if it counts because I need the 230. The higher ones count.
Okay.
But I wanted this to be my foundation.
Oh, no. You did a good thing. I get a surprisingly large number of people sort of in your spot who are tax preparers. Mm-hmm. And they're like you, they just need these few extra accounting credits. Yeah. I have a student, I call him my favorite student because he's older than me. I'm in my 70s and he's way up in his 70s. Yeah. He had to take 230 a couple of years ago to maintain his real estate broker's license. Yeah. And he liked being on campus. He liked hanging out with the kids. Yeah. My long story short, he's taking every business course you can imagine. He's taking 110, 230, 240. He's taking the tax course. So anyway, hopefully you enjoy the courses too, right?
Yeah, of course.
So, all right. Well, Anthony will have to join us, and I may or may not trim this first part of the class. Fine. Yeah, it's okay with me and you. There's a certain boss of mine that doesn't really like me chatting. All right, here we go.
We're still early on.
Oh, yeah. And then this is not going to take too terribly long here. Okay. Well, if you said you went into chapters 10 and 11, one thing you probably noticed right away was that they're sort of the reciprocal of each other, right? Mm-hmm. Chapter 10 is about cash receipts. No, it's not. I don't want to say that. Chapter 10 is about sales discounts, selling things on credit. Chapter 11 is the opposite, the purchasing side. Right. And they're not completely, they're not exact mirror images, but for the most part, they are. So let's start with chapter 10.
Let me get some notes.
And I'm trying to find the save button here. Hold on. Not save, but Okay. Can you see the PowerPoint now?
Yep.
Okay. I have to do a little cleanup on my end here. Did you watch the basketball game yesterday? You're not interested in the...
I work 14 hours. No time. And then I go home and have to help with the kids. And then I eat dinner at 9, and then I study till midnight.
It's good for you, man.
It's like,
Okay.
yeah, there's no games right now.
Yeah, well, I mean, if my life depended on not watching, I'd probably still watch them. Big sports fan. Anyway, Baylor, what a great team. They killed Gonzaga last night. All right, here we go. We're talking about accounting for sales, and they do say cash receipts. That's just a small part of it. Businesses typically make sales on account, right? They're going to sell something, and they're going to get paid 30 days later. And we have a new guest here. Aranza, is that you?
Good morning, yes.
Hi, Aranza. Do you want to show your face like the rest of us?
Yeah, just give me one moment. I'll be getting to my house right now.
Okay.
Oh.
You came at the right time. We were just beginning.
Okay.
All right. So yeah, I work better with a live audience, you know. I'm like Jim Carrey. I need the energy of an audience to. So we'll wait a moment for Aranza to show up and even give Anthony a little more time to show up. He has not missed a class yet, and Rodrigo's here. You did okay on the test, huh, Aranza? There she is. How you doing?
Good, how are you?
How'd you do on the test?
Well, I haven't had a chance to take it because I've been working on it.
Oh, geez,
So I
okay.
today.
Okay, well, it sounds like we need some special arrangements here, because I don't think you can get to it now, but okay. Hey, Kay, all right, here we go. This will be the official start of our meeting. Chapter 10 and 11, sales on account, chapter 11, purchases on account. We're going to talk about a couple of new contra revenue accounts, merchandise sales, merchandise. We buy something from A and we sell it to B. Merchandise, you're buying something and then selling it at a profit, hopefully. And the sale is a transfer of merchandise from one to another in exchange for cash or a promise to pay cash. We know what the retailer is. The retailer is Macy's, Nordstrom, 7-Eleven. The retailer is the business that sells to the end user. And that's not too important in this chapter, but it has a big impact in terms of taxes and other considerations. So a retailer sells to the end user. I buy my jug of soda every morning at 7-Eleven. I am the end user. I have to pay the sales tax. 7-Eleven, they buy it from a bottler. The bottler buys it from Coke, etc. Okay. I'm not going to get involved with the documents. You know, when you buy something, there's going to be a cash register tape or an invoice or something. Wow, here's a sales ticket. How about that, Aranza, huh? That blow your mind, huh? Not much to it, right? It's an invoice. It's an old-fashioned looking thing, but this is what an invoice looks like, the quantity, the amount, and all that. And in accounting, in your accounting department, you're going to get a copy of this thing, or you're going to get it in the form of an email or some form where you can choose to print it out or not. You're going to use this to prepare your journal entry. So it's a simple thing, but very important. The wholesaler, that's the middleman, purchases merchandise from the manufacturer. The middleman sells to retails, usually on account. I would say almost 100% on account. And invoices are generated for each sale, whether it's a sale by a wholesaler to a retailer or a retailer to us, the end user. An invoice is going to be generated. One copy, and now they're talking about the different copies, and this is pretty typical. You got an invoice there in a couple of copies. Well, you send one to the customer, believe it or not, so he can know what he's going to pay you. And then accounting certainly has to have a copy of that invoice. And one could even go out with the merchandise as sort of a packing slip. So you mail one to the customer, but you also might put another copy in with the box that you're shipping out. Wholesaler, retailer, that's low-hanging fruit for the test, huh? Sales transactions, just take a quick look here. It begins when a customer provides us with what's called a purchase order. A purchase order, which is the subject of Chapter 11. We open up our computer and out we get an email from a customer, and we see he's giving us his purchase order. And that is a request to buy some product from us. And if it's a new customer, we might have to do a little thinking. We might want to check his credit and verify a few things. But if it's a regular customer, we just skip and we ship the goods out as soon as we can. We provide these 3 copies of the sales invoice. So this is the real basic introduction. And here's a sales invoice, not much different. This guy bought some gallons of paint, I suppose. Picasso painting, huh? That guy could really paint houses if you know anything about Picasso. Anyway, it's $580. You're going to take that invoice and you are going to debit accounts receivable and credit sales with that. Credit memo. Now here we're getting into some new territory and a good chunk of this chapter that I'd like you all to understand. You kind of have to understand it. A credit memo, let's not worry about what a credit memo is, other than it's the permission, in this case, to return something to the store. Maybe you bought 10 toasters for your company's cafeteria, and one of the toasters doesn't seem to do a very good job. So you call the store and say, look, I'm going to bring this toaster back, no problem. And the guy says, no, you can bring it back. We'll give you a refund. Here's your return number. That would be an example of a credit memo, just permission to bring the goods back. When you're doing that, it's called a sales return, okay? Hey, Aranza, Rodrigo missed some very hard stuff, didn't he?
Yeah, a little bit.
No, we were just looking at an invoice, what a retailer is, a wholesaler.
Okay.
So here we go. Now we're getting into the chapter here. Customers return things. That requires us to record that as an accounting transaction. A customer may say, I want to return this product. I paid $100 for it. I want to return it. I want my money back. And we say, look, we don't want it back either. How about I give you $30 off on it and you keep it? If you say, okay, that's called a sales allowance. So you're going to see a new general ledger account called sales returns and allowances to record that type of thing. The one thing I'm going to start us off with is you never debit sales, never debit sales. But you do have to reduce the sales, and you do so with an account like sales returns and allowances, which is a contra revenue account. Sales have a normal balance of a credit. Sales are increased with a credit. These contra revenues are increased with a debit. The amount that you actually bill out to the customers, we can call that gross sales. These returns and allowances and a couple other things you'll see shortly, when subtracted, give you what we're going to call net sales. And net sales is where all the action is, okay? So we gave a customer permission to send something back. And the credit memo can look just like the invoice, or it can be just a verbal thing, a note, a text. Merchandise sales accounts, okay? So here's what we're going to talk about in this chapter. To account for merchandise sales, we're going to show you some new accounts. Well, sales isn't really new, but let's call them sales, not revenues. Sales is a better word. Revenues implies almost any kind of income. It can be service income, interest income, donations. Sales very particularly says we've sold a product to somebody. So we got sales, and guess what? There's going to be sales tax collected. If we're a business, if we're selling to an end user, that end user is likely to have to pay us sales tax, and we have a certain responsibility for that money. Sales returns and allowances we just described. Customer refunds payable, I'm not going to go over that. And perhaps later in, before we sign off today, I'll explain why. Just all the teachers agreed that that was not a worthy thing to look at. Sales discounts, this is an important one. Sales discounts. This is not the kind of discount where you walk into the store and you want to buy a computer and you say, hey, that one's on sale. There's a big sign, $200 off. Now, that's called a trade discount. That does not get recorded as an accounting transaction. A sales discount, as you'll learn shortly, is an inducement to your customers to get them to pay earlier by offering them a discount. So let's see what we have here. Let's see what, whoopsie doo. Got those happy fingers again. Let me move this over. What's that? Come on, zoom. Okay, so let's take a look at what we have here. We're introducing a few new accounts. Sales tax payable, well, that's clearly a liability. And also we've got sales, which is not really new, but we're calling it sales because we were working with the word revenue more. And now you're gonna have sales returns and allowances, which have a debit balance, sales discounts, and also credit card fees. Credit card fees. When I paid $2 this morning for this bottle of soda, I charged it on my credit card. Well, that means that 7-Eleven is not going to get $2 for that sale. They're only going to get $1.97 because Visa takes maybe 3 cents off the top. So that's another reduction of the gross sales toward net. The sales account, a revenue account, but we're going to call it sales. Sales of merchandise. When we say sales, we're talking merchandise. Credited has a credit balance. And if it's made for cash, we're going to debit cash. But in this chapter, we're not working with cash sales. We're doing the other part on the bottom. We're going to debit accounts receivable and credit sales. And they're just reminding us sales account is credited even though we've not been paid yet. The sale is recorded at the time you ship the product out. We don't care when we get paid at that point. We hope to get paid for sure, but we don't particularly worry about it at this point. Okay, let's talk about sales tax payable. This is going to be our liability to pay, but it's not our money. It's money that the customer paid. We sold something for $1,000 and the sales tax was 8.5%. That's $82, $850, or $85 rather, in sales tax we received. When we get that money from that customer, we have a fiduciary duty to turn it over to the appropriate tax authority. And most states require retailers to collect sales tax. And it's going to be credited when the taxes are collected. We're going to get their money and we're going to write a 3-line journal entry. We're going to debit accounts receivable and we're going to credit merchandise for 1,000. We're going to credit sales tax payable for 85, and that debit to accounts receivable is 1085. And we need to get cool with that. And here's an example of a cash sale. Notice that the cash is 105. The customer paid us 105. Only 100 is going to end up in our bank account. The other $5 are going to be turned over to the appropriate agency, the state. And here they're showing more what we're talking about here. We're going to debit accounts receivable and get paid later. So sales tax payable. Talk a little more about the sales returns and allowance. It's called a contra revenue account. Contra revenue account used to record sales returns has a debit balance, huh? shown as a deduction from sales on the income statement, because you never debit sales, never. And I've got the guitar right here. If you guys can't figure that out, I'll start singing the Never Debit Sales song, and that'll force you to learn it, believe me. This account is debited rather than sales so that the business can keep track of this activity. Companies want to know how much they billed out. Well, we billed out $1 million. Well, what were the net sales at the end of the month? The net sales were only 800,000. Don't you think companies would want to know why they lost 20% of their sales? How much of it was due to sales returns and allowances? Are they giving out a generous discount that everybody's taking? Did everybody use credit cards? Excuse me. Sales returns and allowances. Well, here we go. Now let's take a peek. Refer to the credit memo. Remember the credit memo? Sales returns and allowances. Our customer returned $46. Let me say it this way. This customer returned $46 of merchandise. So we debit the merchandise account, the sales returns. Just like the sales number is always a multiple of the units sold times the selling price, same thing here. This is going to be 1 unit times 46 or 2 times 23 or whatever. We have to refund him his $2.30 sales tax on that, huh? You know, you go to a store and you return something for $50 and the guy hands you back $50. You say to him, where's my sales tax? And I don't think he's allowed to say, well, that's not our policy. We don't return the sales tax. This is what it looks like. You debit sales returns and allowances. You debit the contra sales account, and accounts receivable is credited. Okay. Any questions? Jump in. Let me know. This is a little new, and it's a little tricky, I think, when you first start seeing these contra revenues, which we really should call contra sales accounts. This is exactly what we're not going to worry about, this estimated and accrued returns stuff. So I'm going to skip this. Now, here we go. Now we have our second contra sales account, sales discounts. This is a contra sales account. It's got a debit balance. It records the discounts given to customers who buy on account. Businesses offer cash discounts to encourage prompt payment. Prompt collection of accounts receivable reduces the risk that receivables will be uncollectible. Got a debit balance. And again, on your income statement, you're going to see the words sales, or hopefully gross sales, minus sales returns and allowances, minus credit card fees, minus sales discounts. It has a certain language, all its own, that you need to master. So take a look at this. 210 net 30. You need to understand this like the back of your hand, okay? 210 net 30 is read as follows. 2% 10 days, net 30 days. What this means is this customer gets a 2% discount if they pay us within 10 days. Otherwise, they pay the net amount, no discount. So a 2% discount, if someone offered you a 2% discount, if you pay within 10 days, you would be nuts not to take that, because that equals something like 37% a year. If someone's willing to give you a discount of 2%, it's in essence, it's a brief loan. 2% is about 37%. And I think we're going to demonstrate that shortly. Notice, once you understand 210 net 30, you know them all. 110 net 30, 2 end of month net 60, 310 end of month net 60. The main one we're going to be talking about is 210 net 30. That's the one that has historically been out there. although I don't think companies are offering it quite like they used to. In the 230 course, I assigned 2 companies that you guys analyze all semester in the form of these financial statement analysis reports. And it was interesting to learn that General Mills, big cereal manufacturer, competing with Kellogg's, the other company in my 2 companies, they called all their customers up and they said, we're not giving out any more sales discounts. We're tired of being a bank for you guys. We're tired of paying you 37% on the discount. And what the customers did, of course, they weren't happy. So they said, well, what are you going to do for us? And what General Mills did was they said, we're going to change our terms from 30 to say 50. So that meant that 37% is now on the burden of the buyer, but it's a good thing. It's a good thing to get that discount. 210 net 30. 210 net 30. Here we go. Merchandise was sold for $100. The terms are 210 net 30. Look at the entry to record the sale. We debit accounts receivable and we credit sales. You notice, everybody, we don't have any reference to the sales discount at the time of the sale. You don't worry about the discount at the time of the sale for obvious reasons, among which is we don't know if this guy's going to take the discount or not. We can't assume he's going to take the discount. We have to wait and see if he pays us on time. So he apparently paid us on time. So he sent us a check for $98 that settled $100. He owed us $100. He's entitled to the $2 or 2% discount. So the cash we received was only $98. Hopefully both parties are happy. Our customer is happy because he got a nice big discount of 37% a year. And we're happy because we got his hands on his money right away. We're willing to give up those $2. Describe and use the AR ledger. Ugh. We're going to look at a couple of sales here, a couple of transactions. April 4th, sale number on account to Enrico Lorenzo, okay? Sale on account to Brenda Myers. Every one of these transactions is the same coding. Each one of these transactions is on account plus sales tax. So our journal entry is going to look like this. And I'm going to blow this up. Blow the whole class up. So if you look, the journal entry is the same. Journal entry is the same. We debit accounts receivable. We credit sales for the cost of the merchandise. The sales number is always going to be the units times the sales. So we sold maybe, I don't know, 2 things for $760, whatever. The sales tax is $76. So when it comes time for this customer to pay us, he has to remit $15.96. He's got to pay us the sales tax as well as the merchandise. And these other entries are all exactly the same. So I guess you're going to practice this on your homework, huh? We see those entries. Now we post them to the general ledger. And we know how to post the ledger. We put a date, an amount, and the new balance, and maybe a journal code or something, journal entry page. And here we go. Zoom. Okay. So take a look at your general ledger here. Here are the journal entries. Every one of them, they're only showing 2 of them, but that's okay. In these entries, we debit accounts receivable, we credit sales and the sales tax payable. So we bring that over to the general ledger like this. Here is accounts receivable. We had 12,000 at the beginning of the month. After we sold something to Lorenzo, it went up to 13,596. And after Myers bought something on account, accounts receivables growing. Same thing with sales tax. Notice there was a zero balance at the beginning. That implies that they're remitting the sales tax monthly to the state. California, I believe, I should know this. I did this for so long, but it used to be, I believe, quarterly you remitted. Do you know anything about sales tax, Rodrigo, as a tax guy?
Not really. I don't have to deal with that part, but it
Right,
depends
right,
on
yeah.
the amount of money coming through is when they have to do it. So if
Yeah.
little accounts is quarterly, and then if it gets past a certain number, they want it monthly now.
There you go. Thank you. Thank you. When I was doing it, it was quarterly, and maybe we were considered a small account. I don't know.
Well, because everyone's online now. Everything's you log into
Yeah,
the account,
yeah.
it's all accounts already in there. You just kind of submit it and send it. It's not like you have to fill out forms anymore.
Yeah, the days of walking down to the bank are over, huh?
Well,
I worked in downtown Los Angeles, and I actually liked to say to my staff, "I'll be gone for a little while. I need to go to the bank and make these deposits." Get
Yeah.
out of the office. Those days are over. So you look at your sales tax payable. It started off at 0. It grew by 76 and 22, and your sales go up. You will never see a debit on the sales side. Never. You never debit sales. Never debit sales. Jesus. We posted just now, right, to the ledger, the general ledger. Say hello to one of something that's called a subsidiary ledger. In this case, the accounts receivable ledger. The general ledger is called general for a reason. There's no real detail here. For example, on accounts receivable, your auditor is going to come in, and the auditor is going to say, "How much do your customers owe you?" And you say 14,058,000. Okay, he'll say, "Show me who those people are." Well, now you're going to go to the more detailed ledger, a subsidiary, general subsidiary, and you can have others going below that. Separate ledger contains the individual accounts receivable, and it's going to list each customer and how much they owe. There's not much more to it than that. In fact, there is no more to it than that. And then you're going to have a summary receivable account maintained in the ledger. So let's take a peek here. Posting to the AR ledger. You enter the date, you enter the amount, and you enter the new balance, and you enter the journal page number. It's really a snapshot of your general ledger, just in more detail. So let's take a peek. And again, we're just working with those first two entries. Enrico and Miss Myers, okay? So here's our general ledger up here. We just looked at that. Here is the AR ledger. Oh, geez, went too far. Here is the AR ledger. Instead of having one ledger page called accounts receivable, we're going to have a similar ledger page for each customer. So get a load of Lorenzo. He didn't owe us anything, and now he bought something on account. He owes us $1,596. Brenda had no balance, owes us $462. So really not that much to it. And the only thing we're going to do at month end with this is we're going to prepare a report, like a trial balance almost, where we're going to list every customer, probably in alphabetical order, with the balance to the right. And when we add that balance up, it had better equal whatever the ending balance is here, okay? What your auditors are going to do at this point, they're going to say, okay, thank you. Now you might have 100 different customers here, 1,000, that comprise that 14 million. What the auditors are going to do, they're going to look for some of the biggest ones, and they're going to pull some of the mediums and even a couple of the small balances. And they're going to have you sign a letter saying to the customer, "Dear customer, you have my permission to verify these questions from the auditor. I really appreciate it if you do that." And they always will. Customers are glad to do that for you. And that'll give the auditors a little more comfort that this AR is correct, that you're not trying to pull something. Entries in the general ledger are posted to the ledgers, both subsidiary and general. The total of that subsidiary ledger, the total of all the balances due your customers must equal the general ledger balance, okay? Accounting for sales returns and allowances. Here we go. Let's have a little fun with this. Sales returns and allowances. Well, let me see something here. Okay. I guess they're just showing one person here. Okay, they went to the third person of those journal entries. Here's the journal entry to record the sale to Wilma Cutts of Lawrence, Kansas, home of the University of Kansas, the Jayhawks. We posted to the ledger right here on the bottom. We posted the receivables. We posted the sales tax. That's the payment there. So take a look here. 4830 was the debit to accounts receivable. Same thing here. Here is a sales return. We had sold this person $48, what was the number? Get the right exact number here. We sold them $46 worth of merchandise. We sold them something for $46 plus sales tax of $2.30. Now they're returning these goods to us. We gave them permission to do that. So now we're going to credit accounts receivable because this customer no longer owes us $48.30. We're going to have to also give them back their sales tax of $2.30. So the new balance in the customer account is now $651 minus that equals $602.10. Not too hard following these schedules, Aranza.
I'm following along.
Yeah. Okay. We're doing good here. Okay. Credit card sales. That also creates a contra revenue. You see businesses, you don't see them too much anymore, I don't think. Once in a while, you see a business that says cash only. Well, they don't want to pay the credit card fee. And obviously, they're going to be turning away a lot of business, but maybe they don't care about that because they don't want to get involved in the world of credit cards, which makes them spend money on a machine perhaps and some extra paperwork or whatever. So credit card sales will reduce your overall gross sales. I buy my soda and it costs 7-Eleven 3 cents. 7-Eleven would be much happier if I handed them 2 $1 bills. That way they get $2. Here, they're only getting $1.98, okay? Credit card sales. On a sale of $100 plus sales tax of 5%, the credit card fee at 4% would be. Now, I don't know about this, to be honest with you. You don't pay sales tax on you don't pay the credit card. Yes, I guess they do. Okay. I'm thinking through it too much. I was thinking for a second that, geez, they don't take 4% of the sales tax amount too, but I bet they do, huh? It's for the total. So 4%.
Yeah, they get the total. They don't care what the stuff was, is whatever got processed on the credit card is what they take their percentage of.
Yep. That I did know, but this threw me for just a second here. I'm glad you reinforced that though.
Yeah, they don't care.
Yeah, no, the feds are brutal, you know.
Yeah.
Okay, so what do we have here? We had a sale of merchandise for $100. That's our credit. We have to credit sales tax payable and we have to debit cash for $180 because we had to deduct the $420. In other words, this customer could have paid us $105 if it was a cash deal, but because they used a credit card, we lost $4.20 to this contra revenue account, contra sales account, which carries a debit balance because you never debit sales. Let's look at some cash receipts. Well, we have receipts on cash on account. Hey, they're throwing in a cash sale here. Here's a credit card sale. So the bank credit card expenses on these sales are $900, okay? So let's look at some journal entries. Okay. Oh, sorry, guys. Got the happy fingers. Ah! Okay. Now I'm getting a little annoyed with this thing. Try it again. Okay, it looks like I need to zoom it just to be able to manipulate it. Okay, they're showing us the first couple of sales were real basic. Cash sales, cash payments, it looks like, huh? Lorenzo paid us. There was no sales tax involved. Let's take a look at what else we have here. They're bringing it over to Lorenzo's and Myers subsidiary balance. Looking at accounts receivable. Boy, this slide is a dud. It doesn't do much other than repeat what we saw before. But I've got other things in store for us. And here's your schedule of accounts receivable. At the end of the month, look at this demanding schedule. It's not too tough, huh, Rodrigo? You're looking at the general ledger, and you're making sure that the general ledger equals this total of 14,331, and now you're showing who owes you the money, okay? I'm not going to worry about finding accounts receivable errors. Now, I have one other treat for us today, okay? I want to show you this, or this. Here we go, not that. Okay, let me share the screen here. Let me move this out of the way. Okay. We're going to go through this briefly. Here are some transactions. We sold merchandise, terms of 310 net 30. Here we sold something on a credit card. Here we sold items. It doesn't look like there was any sales tax. Somebody returned something. Somebody paid us on time. Somebody paid us late. I just want to show you how you would bring these over. Sold 20 items of merchandise for $5,500, terms of 3% 10. There's your 5,500, and the sales are 5,500. Okay. Sold items here. And Visa charged them 2%. So that's what, $8 coming out of that transaction, right? $8 is coming out. So accounts receivable has to be the 400. Accounts receivable. Oh, there's no accounts receivable to credit card. That's the sale, 400. God, thank God. There's the sale, $400. But take a look. You've got this credit card fee, debit to reduce sales because we never debit sales, and you only get $392. We sold some items here. And let's find a different one. Customer D returned something. Customer D returned one of the items on the 28th. Well, they bought 10 items for a total of 9,000. Each item is 900. 900. So that's the amount of the sales return. Let's look at our sales returns and allowances. There it is. Debit 900, credit accounts receivable 900. They don't owe us that money anymore. If there was sales tax involved, the sales returns and allowance number would be the same, but this would be 900, say $50, and you'd have the sales tax payable for the difference. Customer D paid in full. Customer D, that's this guy. He paid us on the 6th. Let's see, 30, he paid, he bought it on the 30th. Well, he paid us within 10 days, clearly. This guy is entitled to the discount. Now, how much does he owe us? He now owes us now $8,100 because he's the guy who returned 900 of the 9,000. So let's take a look at your T accounts. Well, let's see. He owed us 9,100 or 8,100. I'm sorry. We credit 8,100. Here is the sales return. Let me just go back to that again real quick. Yeah, he paid us, this guy. Yeah. So here is the 8,100. He relieved it with just $78.57 in dollars because he gets a sales discount of a certain percentage. And then the last one here, customer B paid, but it took him a month to pay. So he's not entitled to the discount. So this guy owes us how much, customer B? He owes us $5,500. Debit 5,005, 5,005. I have a business question before we leave here. Rodrigo was too afraid to answer this question. He must have known this was coming. You ready, Anzar? This guy paid us late, right? So he's not entitled to the discount. What if you're the accounting boss and you're sitting in your office and you see this guy didn't pay us? This guy took the discount when he shouldn't. Would you automatically call the guy up and chase him down for that money or add it to his next bill? You would be within your rights, wouldn't you? Can you sense where I'm going with this? What if this man or woman was a regular customer who's been buying from you for years and years, and they always take the discount and they always pay on time? Are you really going to chase them down for that $243? Probably not. You probably eat it. That's all I'm getting at, okay? That's a decision you make all the time. And where companies can get themselves in trouble is if perhaps an employee not thinking about that gets you in trouble. So finally, here's where we're going to end up. Take a look at this, Aranza. Take a look at this, please. This is how your new income statement is going to begin. The first number is going to be gross sales minus the returns. Hi, Rodrigo. I was just telling Aranza, I was asking her, this guy, what if a customer took the discount even though he paid you way after the 10-day period? I was asking Aranza, would you automatically chase that person down for the money? Go after him?
Probably not.
How come?
Too much effort and time.
Yeah, that's right. I never thought about that. Plus,
I just wouldn't give him the discount next time.
Yes, you could do that. Also, what if it's a guy who's been buying a lot from you, though?
You
And
just
this
let
one
it
time he
slide.
slipped up. Oh, goodness, yes, you'll let it slide. I remember a long time ago in my crazy world, we annoyed a longtime customer by clipping him for like a $50 discount he shouldn't have taken when he did hundreds of thousands of dollars of business with us every month.
Mhm.
And we profusely apologized. And I think we lied to him. We told him we fired 3 people who were involved.
Yeah.
But here's what you just missed as we finish up. After you do all these postings, you bring the balance to your new start of the income statement, Rodrigo. Gross sales minus sales discounts, minus sales returns and allowances, minus credit card fees. Okay. So this chapter, I don't think it's too tough, but at least we're getting involved in real world type, situations that we can discuss and you need to be able to handle. When we get into the next chapter, we're going to be calling the sales discount the purchase discount, because the guy who took that discount, to him, it's a credit. He made income by saving the payment to us. Okay. That's about it. Do you have any questions, either one of you, Aranza, Rodrigo?
No,
Not too tough. And you haven't taken the test, Aranza?
Getting that today since I heard the day off today.
Okay, we'll
you have no
talk.
choice. It's due today.
I don't think you can get to the test. I think it timed itself out. So I'll talk to you about that. We'll work that out, Aranza. Okay. Do we have a motion to end the meeting?
Yes.
Yes. Do we have a second? Aranza says I second the meeting. Okay, we'll
raised
see you
your
guys
hand.
later.
That's close enough.
Hey, bye now.
Bye.